So good afternoon, everyone. Greetings from Asia to our audience for this conference. As the first panel discussion, I'm very happy to welcome our panel members. To this panel, we have three major parts. The first one is, did captives have a good COVID? Second is new challenges for risk managers. And third, global risk trends. So without further ado, I would like to then kickstart this panel discussion. Mr. Halim, may I select you as the first speaker to answer a question? So how have the insurance buyers reacted to this crisis the past 24 months?
Thank you very much for the question, Harusan. And very good afternoon to everyone, all the listeners, ladies and gentlemen. It is my honor to be here with you. And very quickly, if there's going to be questions, we can do that for later. But the first immediate thought when Harusan posted this question would be, how prepared were we? In that, unfortunately, most of us were not prepared. So if we're looking at the reaction of the buyers towards the crisis, among the biggest problems was really getting caught with your pants down. I believe, there was a report on the WEF forum, the World Economic Forum, about the possibility of biological risk coming into play as early as in the year 2018. But again, as positive insurers, as well as buyers, I suppose, a lot of us thought that it was like a passing event. Until COVID came, many of us, so going back to the question, many of us were caught unprepared. And to a great extent, a lot of us then got into the wave of things. And by the time we realized, three main things took place. One, immediately, because of the breakdown, we've got breakdown in supply chain. Two, leading towards contractual frustrations. Three, suddenly we get a host of other issues coming on. People getting depressed, economic markets starting to disappear, and a lot of depressive actions were taking place. So given those scenarios, the insurance buyer, I believe at that point in time, by the time they collated all the relevant information and effectively tried to make sense of the available data, was already caught into the bigger scheme of things. Hence, whilst losses didn't really come, we didn't quite see, at least in Malaysia, we didn't quite see a lot of social problems, i.e. people were not burning down their own factories and all that, but we were getting the normal stuff. But more importantly was the poor engagement in terms of having to deal with contractual frustrations and breakdown in supply chain. So with that, there were a lot of occasions when ART, or we call it alternative risk transfer, came into play. And I think the real problem, Harusan, and this is for the benefit of all, in Malaysia, what I started to see then was, because insurance are managed by insurance managers instead of risk managers. So therefore, insurance managers were looking at practical approach in terms of transfer of risk instead of understanding the risk and dealing with it. So I hope with this pandemic, we all learn from all this, and structural change must take place, i.e. time has come for organizations who are serious in doing business, serious in looking at enterprise risk, must be very real with putting the right people in the right job. Obviously, the CROs, or the job of the chief risk officers, are becoming more and more important. But having said that, the real people who's dealing with the risk, like a risk manager, must be brought into place for them to be able to anticipate what the black swans potentially can be, or how serious it can be. And those are among the lessons learned, Harusan. Thank you very much for the question.
Thank you, Mr. Halim. Can I throw now a question to Kelvin? What were the tools employed to handle all these points Mr. Halim have mentioned, by different organizations to get them through the pandemic?
Thank you, Harusan, and good afternoon, everyone, to the audience starting into the conference today. So I think the broader question behind here was around the fact that I think prior to even the pandemic, if you look at the insurance market in itself, right, it was already looking to be a difficult one. The market was already hardening, rates were going up across the board. there were all the usual signs of indication of contracting capacity, restriction of coverages, so on and so forth, right? So the pandemic was not the cause of it, but it exacerbated the situation and it just made it more difficult. Like in terms of what were the coping mechanisms that risk and insurance managers were utilizing during this period, it's quite an interesting thing, right? Because a lot of the usual avenues that were available to insurers, to buyers, were not readily available this time round, right? So the ability to meet with carriers, to lean on relationships for escalation to senior management, road shows to pitch our risk, so on and so forth. All those avenues were being denied to risk buyers, right? And whilst we were still able to have some form of interaction with the brokers, with the market through a webinar, through a virtual platform like this, it's far easier for insurers to hide behind the screen and have a difficult conversation with the client in this case, right? And I think I speak for the clientele across the region when I say that the conversations with the market for the last 12 to 18 months has been a difficult one, right? There were difficult renewal conversations where insurers were prepared to walk if you weren't going to meet the terms. So this then forced the hand of risk managers, like what Halim said about turning to alternative risk transfer, about leveraging other mechanisms to try to plug the gap. So definitely, I think you would have seen an uptick in the utilization of captives, right? But then this ability to leverage on tools like captive is a bit of forward planning as well, right? So in the absence, if you were being a bit reactive and being a bit short-sighted in the way you were managing your insurance programs, then you could have only done so by self-insuring, by either increasing your deductible or reducing the limits of coverage and all that. But the ability to leverage that captive participation requires a bit more long-term planning. So I would say, broadly speaking, you will see risk managers turning to alternative tools to manage it. But the kind of tools that were available to them might differ depending on how much long-term planning and thought has gone into a risk financing strategy to begin with. If you have always been relying on driving rate style and thinking that coverage is cheaply and readily available, you'll be less exposed. But if you have always been very conscious about your own internal risk financing strategy, what is your risk appetite, what are your retention levels, and have the tools like the captives and all that to the infrastructure to support it, then you would have maneuvered this situation a little bit differently. That would be my call.
Thank you, Kelvin. So in connection to that, maybe Shiwei, have you seen higher recognition of people requiring more of self-insurance tools and vehicles through this pandemic period?
Yes, absolutely. So the pandemic, mainly the effects can be highlighted in three aspects. I would say the why we are going to use more, look into more self-insurance such as a captive, and secondly the how, as well as the who, i.e. what we have talked about, the risk manager, as well as the wider community as well. So first, let's come to the why. Why we are putting more and more effort and looking to the alternative risk transfer solution, especially the self-insurance, is because exactly what Halim has mentioned, the impact of the pandemic, particularly on our economy, and that as a consequence on the company's business needs, which shifting from efficiency-driven to resilience. Just as he said, the business interruption, the economic distress, put the company think, hang on, we need to stop and review, especially it's relevant for Asia, as the companies here, we are very much driven, especially by the growth, entering into new market, putting forward new products, rather than take a step back looking into our enterprise risk management in a holistic manner. And just as Kelvin said, those who have a bit more long-term view and also enterprise risk management, that would maneuver it differently. So the why indeed is changing. The pandemic absolutely heightened that recognition level. We need to do something different. Secondly is regarding the how, because before the pandemic, and just as Kelvin mentioned, the hardening market actually preceded the pandemic, but it has been heightened by it. And with the limited interaction, but then on the contrary, we also have an enhanced interaction among the peers. You know, the webinar, the FIRMA, the PARIMA, as well as the conferences like what we are having now, and also the media such as the Global Captive podcast, that bringing the risk management community closer and exchange how we can tackle this, then become more visible on, okay, that companies with a captive, they now put it into their global programs into the captive from a fronting perspective. The overall insurance cost and risk management cost become more transparent and efficient. And that company with a captive, they have putting in the employee benefits into their captive, and therefore their coverages can go above and beyond what is available in the market. Those solutions and how to do it, together with the ecosystem such as Labuan provided, and also the consulting, etc., the captive management, they all providing the thoughts and also the sharing the knowledge, and therefore the how become much clearer, as well as just on the paper, what are the benefits of captives. The lastly is on the people. I think it's really at the who, as Halim well put it, is we need to change from the kind of insurance purchase responsible person into a real risk management person. And this pandemic has indeed put risk management, especially the person, either it's an insurer bias or finance person, legal person, or official risk management team into the center. And their visibility, because of all these business interruption and the impact on the people risk, etc., they are much more connected with the various functions within their company and in front of their C-suites. So the emphasis on the dedicated risk management become much more important. And the person who are in the dedicated position is more empowered as well. So the pandemic indeed has heightened the who, which can carry out that long-term risk management strategy. And by doing the long-term risk management planning, you review your risk, you assess it, and also evaluate whether your strategy to transfer, retain, and mitigate is still valid or not. And the self-retention and whereas a captive just become a very important part of that. So this is why pandemic indeed has put more recognition for the self-insurance.
Thank you, Shiwei. I mean, I think, you know, both Kelvin as well as you have mentioned a couple of times, I think there's this signature term, risk management. And I believe we will very soon come to that. But before that, I would like to ask Malcolm, you know, do you think you being positioned in Europe, you are, you know, kind of objective view from Western side of the world towards Asia, especially towards Labuan, you're a specialist of, you know, lots of captive structures. Do you think captive, to come to the point, have, you know, step up to become a, you know, strategic risk management tool now?
It's a great question, Haruhito. If you ask me, did captive step up as a tactical tool, I'd say absolutely, and they added real operational resilience. But as a strategic tool, I would say probably the jury is still out. So, you know, we're very lucky that Aon and Marsh release some very good information annually about their captive portfolios, and that accounts for about half of the captives worldwide. So there's a lot of information available about what's been going on, and hopefully that will help us work out what's going to happen in the future. So if we look at the existing captives, and this is to pick up a little bit on what Kelvin was saying, those captives stepped up and they used the spare capacity in them to take on more risk. Now, captives traditionally are very conservative underwriting vehicles. When I started in captives, capital to premium was about 300%, extremely conservative. It's now gone down to about 200%. And I suspect that what we'll see next year when 2001 stats come out is that more of that capital is now being applied to deliver capacity. But there's even more capacity available there. I estimated that if captives underwrote as traditional insurers did, they could actually provide $1 trillion of capacity, which is a huge number. But that's, you know, that's for the future, I think. If we look at what happened in 2020, we really got more of the same. So captives were writing really the same risks that they'd written before. That was the property damage, liability, marine cargo. They were just writing more of that risk. So tactically, a very good play. Strategically, I'm not quite so sure. The other thing we saw was that because these captives are so well financed, there was actually a lot of surplus cash available to be released to go back to the parent company, and that would help with some of the cash flow issues that some companies experienced during COVID and the hard market. Looking at the growth, the new captives, really it's quite patchy. You know, you look at Europe and they had virtually zero growth, but in Asia there was a growth of 25% last year. Now, I accept that's on a relatively small base, but even so, you can see that the use of the captive was appreciated in Asia Pacific. But the growth predominantly was in sales. They're quick to set up, they're low cost, they're low maintenance, which suggests to me they were used for specific purposes. And I'd certainly seen a lot of sales created to deal with the professional indemnity challenges of a hard market. I've seen them used to access reinsurance, to try and get into the wholesale pricing. I've seen them used for D&O coverage, which is something new. And occasionally they've been used to provide some sort of cyber or environmental risks. So those are relatively new, but overall, the captives are really just being used better for what they've been used for in the past. Moving on to the strategic question, I'm not really seeing captives being fully integrated into the group's ERM. And again, this picks up some of the points we heard from the earlier speakers. To me, in many cases, captives are still at the back of the queue. It's almost, I wouldn't say an afterthought, but the strategic risk decisions are being made at the main group board. And ultimately, they're trickling down to the captive in terms of, well, can you take more risk? But they're not actively involved in the discussion at the beginning. And to me, captives still have a lot of headroom that could be used to respond to the COVID situation. But what it really needs is better linkage between the captive board and the parent company, and they need to be more involved. And with that, really, what we need to see is the captive board driving the vision for the captive, and really making full use of what the captive can deliver. So, in summary, a good COVID and hard market as a operational resilience tool. In terms of changing the strategic direction of the parent company, not so sure.
Thank you. This is perfect summary, Malcolm, because this exactly brings us to the topic back in terms of risk management and the challenges we want to discuss about the future risk manager. As said, in the company head office level or operational level, and between the risk management tools like the captives we are discussing today. So maybe, Kelvin, can I throw this to you again? What do you think a risk manager in a corporation, businesses have to become? I think we have to also require them to change how the entire risk is managed on an enterprise basis and on a holding basis. What competences do we need for future risk manager in these enterprises?
Thank you, Haru-san. You are asking a question that's very close to our heart at PARIMA, the association, right? Because when
happy to do that.
This is something that we are grappling with, to essentially talk about what are the competencies to the risk manager of the future we need. And I guess without even looking that far ahead into the crystal ball, there are some short-term possibilities that risk managers can already focus on right now already, right? So to allude to Malcolm's point, the fact that a lot of the involvement of insurance, risk financing, captive utilization is seen to be a tactical thing and not a strategic thing, can be driven by the behavior of the risk and insurance manager within the organization and how you position yourself as well as the business owner, business leader of that function, right? So if you have always looked at it very transactionally, if you have always tried to show your value and worth in terms of the cost savings you are generating to the company in terms and that's how you position the function as a reactive one, then that's how the function will be valued as well. So I think there's a lot a risk manager can do to lead and change the perception of that function from within, and that's how you also pitch it internally. But of course, in order to do so, you have to be prepared to answer the questions now on a different level as well, right? So for example, if you are a risk manager who is leading and owning a captive with a P&L responsibility, then you have to be prepared to translate that into the language of the organization that you're working for, right? You have to be prepared to talk about the business planning of the captive. You have to be prepared to talk about the financial implications of how a captive can support core business activity of the organization. You have to translate your insurance and risk methodology and jargon into language, the business language that your organization can understand and relate to in terms of the cycle. So that is not a prescriptive thing. That is quite a unique thing that is inherent within each company. They all have their own way of financial cycles, business cycles, client-specific contracts and demands that you can always lean on the captive to respond to this sort of thing. So I would say one of the core competency that risk managers should look to is the ability, right, to translate, to navigate risk and insurance theory and methods into a concrete way that can support business activities. Because if you want to sit at the table when they talk about strategy of the business, then you better make sure that you have some value to bring to the conversation as well, right? So that's definitely one core point. The other aspect as well is that, well, in an alternative universe, we would all wish to be a little bit more clairvoyant in terms of being able to see what is coming our way, right? But unfortunately, that is not going to happen, right? But what we can do, though, is to try to ensure that the company and the team and the individual can respond in the right manner. So you can't control what is going to happen, right? And not least if you have ran a dozen, like 1 million risk assessment and simulations, there wouldn't have been a single one that could have predicted both the duration and the severity of this pandemic phase that we were going through, right? There were a lot of aspects of that which were probably extremely difficult to foresee. But you could have prepared the response of an organization to things that are foreseeable, right? An extremely difficult insurance market with limited capacity and an inability to secure certain kind of coverages that might be critical to key business activities and operations. And how do you plan around that? The ability of an organization to respond to a business interrupting event, regardless of what that might be, and how your risk and insurance function can support that in the worst form of the severity or duration, even if the reality when it happened was way beyond the scope of what we can imagine, right? So these are the things and these are the tools that risk managers should be equipped to think about. and it allows them to then frame the insurance and risk activities in a different light. It doesn't necessarily changes fundamentally what needs to be done. You still need to place insurance, you still need to structure programs, but you are able to then frame that in a different light, and you're able to frame that in a different conversation internally as well.
Thank you, Kelvin. Can I also add Mr. Halim to comment on this important subject? I think it's key also from Asian businesses point of view. I believe many of our today's audience are from Asia. Mr. Halim, you as a Asian manager here, what do you recommend your clients would prepare in your clients' organization and businesses? Right.
Thank you very much, Harusan. Once again, ladies and gentlemen, I think taking the point from what Kelvin said, let's remove complexity from this. And I would like to think, if we can look at three things, structural to some extent, operational to a greater extent, and of course to think strategic is the third point. So to simplify these thoughts or this concept, we have to move from being a reactive business or reactive manager into a proactive manager, hence allowing strategic applications, strategic situations to help us to move along. So as Kelvin was saying, apart from the tools and everything else, is to be able to actually benefit from the in-depth knowledge of a risk manager rather than just an insurance manager. Because the insurance manager will bring to the table his views in respect of perhaps the more basic stuff, like risk transfer. You buy insurance, you pay a certain premium, and that's it. Whereas a risk manager will bring what Kelvin says, systems, methods, control, ideas, concept, moving from just buying insurance into monetizing insurance. I think as businessmen, as enterprise, we have got to think about monetizing stuff so that we don't get into a cost center, but create insurance into a profit center. How do we do this? Given that the pandemic was there, given that tools are available, I'm the biggest fan for digitalized transformation. And that's what pandemic has brought us. Today, everybody is digitally transformed. You all can work off-site from anywhere and everywhere. There are dozens of tools that allows algorithm, that allows you to do predictive modeling. So engage with technology, engage with advancement, engage with this ability to be able to democratize, engage with Industry 4.0, which gives you the ability to make informed decisions from anywhere and everywhere by putting together, by using this application and tools. So if we've got ourselves transformed, and then we can move almost immediately from being a reactive buyer to a strategic buyer. And lastly, ladies and gentlemen, the reality is insurance is not really that complex. You need to have systems, methods, and control. You need to be able to understand the jargon. So please structurally move from just having an insurance manager into having a risk manager who will move up into becoming a chief risk officer and create your ability to monetize insurances. Again, it's all available. And then you look at your alternative risk transfer, which is real. Please then go and have a word with your brokers, your consultants, your specialists, for you to be able to move into your alternative risk transfers, as well as move into captive organization, where you become a pseudo insurer yourself. But to get there, ladies and gentlemen, let's be real. It is a journey. You need to have a conscientious long-term approach to risk management. With risk management, you write your own risk, you monetize your risk, you create a profit center. And I think, Harusan, if at all, I think if an organization is prepared to move from being a reactive to a strategic partner with all the relevant specialists that's available in the market and monetize insurance, that's what enterprise risk is all about. Thank you very much, Harusan.
Thank you. I think, Mr. Halim, this is amazing 2 points. To enable the customers, enterprise, and organization from having a cost center, as the panel members have mentioned, and carrying the risks and the cost of people and staff to reorganize themselves. We have the prospect with that captive solution to have or to give birth to a profit center of the customer's enterprise. I think this is a very strong argument, a strong plus point. Now, may I turn to Shiwei? How do you see, you are sitting in Hong Kong, you have representing a large enterprise. How do you see that this captive is being recognized, and do you see growth in this, or do you think it's just another hip thing and it's not going to last too long?
Thank you very much, Halu-san. And regarding that question, I think we talk about the crystal ball, but no one really have the crystal ball to look into the future. However, from a few trends, I want to highlight whether it will be a passing trend or it will really indeed gain the wider recognition and hopefully become a more strategic tool as part of the risk management strategy. Firstly is I would say when it comes to the more band-aid solution, particularly when it comes to quick setup in order to respond to the hard market, such as the professional indemnity, D&O, cyber that Malcolm has just mentioned. Some of those captives, the companies set up those captives has made it quite clear with their captive consultant, etc., that we will come out as soon as the market change. This is not something we really are comfortable in doing, and we really want to utilize this as a band-aid solution. So you can say that you definitely have certain band-aid short-term solution which would pass once the market condition change. But throughout this engagement, especially in the PCC journey, the company will be able to see as a strategic way how their risk management has been conducted. And hopefully through the captive engagement, they are able to deep dive into their own risks, putting in more risk management solutions. And therefore they will also see, okay, with the captive, actually the losses can be more managed. And we are also improving our risk management. So is there a possibility of making the band-aid, once it's healed, but still something to train on this part of the muscle, right? That's one trend. The other part is throughout the 2019 and 2020, as Malcolm mentioned, the Marsh and Aon captive report. So Marsh report particularly identified a trend. That is the larger captives, especially those premium is over $20 million US, it's become bigger and more because they already have that basis, so that they are looking into, they're making their capital use more, and then they have a bigger seat at the table. They are looking into something really long-term, utilizing structure solution, for example, completely change the risk management philosophy from annual renewal focus into the long-term stability that they are looking at for understanding their risk better, manage their risk better. And then we were looking at the third trend is especially when it comes to certain country like China, because previously there are not that many kind of a risk management role, and the risk management functions really diversified, or put it this way, or is more divided into different functions. So therefore, when the Chinese set up the captive, you look at the 8 major ones set up by their the large state enterprises, it's actually the flagship for their enterprise risk management, rather than just a cost-effective solution or tool. They are the beacon for their completely entire company's risk management, and that can create examples for the peers. So that is a very important trend. I would always say, when you look at captive, we need to really put that into context. Our region, it's very different from Europe and the US because of the economic development, the fast economic development, particularly in Greater China as well as Southeast Asia. So the companies are focused, just as Kelvin said, how you get a seat at table and talk in the way the business heads would listen. Because many times we see some would look into the captive and then the numbers doesn't work. Then they will say, oh, our senior management didn't buy in because the premium saving is not obvious. So certainly it's nothing strategic, right? But once we're on this journey to understand our risk profile better, and to capture that enterprise risk management strategy. I would say I'm more on the half bottle is full, right? Let's look at how it can go further rather than, oh, it's always a half bottle empty. So that will be my view on the, well, without the crystal ball, looking to the future. Thank you, Haru-san.
Thank you. I think that's exactly, we have such a big potential here in Asia. As you correctly said, Shiwei, we are the center of growth for global markets. We have not only China, we have India, we have Southeast Asia, everything throughout the COVID crisis have seen the resilience of the economy growing. And that is because of our businesses and our clients. So Malcolm, can I, as a old wise man in this industry, seek your input on how you would recommend, or your personal experience we can leverage, and especially as a Labuan, the center of captive in Asia, can benefit on this long term to help our clients in Asia as well as global clients to manage their risks going forward, long-term basis.
Well, I think Labuan and some of the other jurisdictions are not first movers, so they have the advantage of looking at what other successful jurisdictions have done, and look at what other successful risk management associations are doing. So all I would suggest really is just copy the best of what's being done elsewhere. You don't have to incur the pain of being a first mover. You don't have to incur the pain of the research and development. Just take the best of what's available out there.
Which we are very good in here in Asia.
I wasn't going to say that, but it did strike me that it was a business model that's been adopted before.
I think that's a relevant comment, right? Take best practices from what has happened around the world, but what we have been very good at as well is adapting it to suit the needs of the market and the region here, right? So we do see a uniqueness in terms of the application of techniques that are not new, but the application and the utilization of the techniques in the region can be something that is quite unique to the region as well. So I think that part is interesting to look at as well.
Thank you. Dear panel members, I have 2.5 minutes to go, just to inform everyone. And we have one question from the audience. If I may quickly read that question. One reason for captive could be hardening of the market. However, even a captive needs to protect from the reinsurance market, which is again hardening. So how effective a captive would be if the hardening market is a reason for going for a hardening market is a reason for going for a captive. Anyone who wishes to answer this? Malcolm, please.
Okay. Well, I mean, the reinsurance market is a wholesale market, and the reason why insurers and captives seek protection is because obviously they think they can get a cheaper pricing. So how do you make that wholesale pricing reasonable? I think by demonstrating to the reinsurance market, one, that you're a preferred risk, and two, that you are taking most of the pain, the attritional losses, away from the wholesale market. So if you can look at the loss experience and you can demonstrate to the market that you are going to be taking, say, the 1 in 5 year type loss, then I think the reinsurance markets are very well suited for taking those, 1 in 10, 1 in 20 year type loss. They'll price that obviously, but it's a more efficient use of your risk financing budget by keeping the attritional losses and premium in your captive and just using the wholesale market for those losses that you can't bear yourself.
Great, thank you. We have actually now additional question which I want to use the time for. The question is, why cyber/professional indemnity/D&O are considered as short-term captive solutions and will move out when the market is softened? Anyone who wish to take this?
I don't mind responding.
Halim, yes, please.
Shiwei. Okay.
Oh, sorry.
Yeah.
I just want to clarify because this might come from my point. So I was giving an example on some of those captives who are forced into set up a captive and taking up those lines. They express they will go out, but it's not like all the captives who are in taking up these lines of business are planned to go out. So I just want to clarify that from the first point. So sorry, Halim, do you want to add your thoughts on that?
Yeah, we got to help Susan understand this. Really, Susan, cyber and professional indemnity as well as D&O are not short-term risk, are not also a captive or short-term captive solution. It's not. These are real long-term policies that you need to have. Simply because everywhere in the world we follow the corporate governance, and in corporate governance, all transparencies and governance must be managed very carefully. And this is where it ring-fences the directors and officers. So it's not like when the market gets better and therefore you don't buy your D&O policy anymore. Similarly, in the same way for your cyber and professional risk, because this risk exists with you all the time. If at all, you need to have a long-term view to all these policies. And if you have affiliation with captives, that's when your risk, as Malcolm said, if you practice proper risk management along the way and create yourself to be a preferred buyer or a preferred insured, this is when your captive and all that can monetize this risk and help you along the way, not just to provide pseudo coverage or real coverage, and use the alternative wholesale insurance market as your secondary provider. So, the reality is these are not policies that will disappear when the good times come back again. No, it doesn't, dear. It is corporate governance, it's transparency, and we require this to protect your directors and your officers.
Thank you all. We have successfully overrun our time. So I would like to thank the panel members for their contribution. Also, thank you for audience to participate in this panel discussion. Very nice to see questions. I hope you will have continuous, very good session, informative sessions and talks today with this conference. Wish you all very best. Stay healthy from Asia. Thank you.
Thank you very much. Bye-bye, everyone.
Thank you very much. Bye-bye.